What's up, everyone? I hope you had a wonderful weekend. I kind of overstayed mine, but I think we are back. Now, in this video, I just want to show you that what we did on our last video, it actually, paid off, because this was the area we are looking at to see a reversal, and we can see clearly that after the market, it's kind of an extension of the last video, but we are also going to do some added content on it so that we can see that this thing is recurring on a daily basis. So from our last video, if you have not checked out the last video, you can go back. It's actually the 5th video, and see for yourself that actually I had called the market right here for a buy. I'd said the buy was going to occur between 10 and 12, and it actually did, and it came out to take out this high that I had already actually outlined before it happened, when the market was right here. In the PM session, I was looking for another entry right between, that is 130, no, that's around 2 to 12:30, no, 2 to 2:30, and this fair value that was here, it kind of gave me a good, price action, because it was retested twice, then the market went above it and retested it on top at the high, then the market now went all the way to our initial target that was above this, this blue line. You can see it gave us some, a good place to get out, because as much as it retraced, if I was to extend this line, you can see that it gave you two places you can get out. And if you're not greedy, I believe that this was a good trade last week. This was last week on Friday. Now, for today, I wanted us to do a bit of markup. How we do our markup, or how we get a bias, or really how I personally do the markup based on ICT strategies. So after the Friday, after Friday, the rally that took out this high that had actually outlined, the market went all the way down, dipped further, and it closed definitely. Let me just show you exactly what I'm trying to say. You know that in indices, once it reaches around 459, the market closes for 1 hour. Then it comes back at 6. So for a whole hour, there was no trading. So a gap actually occurred right here, and this gap is actually a new week opening gap. For the ones that know it, it is NWOG. The other one is NDOG for new opening day gap. So let us see what really happened after the market created this the opening gap, the new week opening gap. As you can see, it occurred on a Friday at 4:59, and now that one gave us, now we have to extend it to the right to see how the market is going to react to it. So let us see whether these gaps actually really matter. From here you can see that actually the gap was closed. That was on a Sunday. The market opened with a gap, closed it, went below it. Then here is where now we come and see on a Monday, that is a midnight time, Monday, market went all the way, but our time is always at 7. Now let us do the markup together. This is a plain now chart. Let us see whether we can do it together. Now we are going to put our vertical line at 7 a.m. right there. Let me just put it right there. I love to put them in black. Then the other one at 8. I hope this one is going to be valuable for the ones who don't know how to backtest. And actually, after you backtest, I'm going to show you what you do with the information you get after backtesting. So this one is at 7, this one is at 8, this one is at 9, the other one is going to be at 9:30, 9:30, 9:30 is right, it's going to be right there. Then the other one is going to be at 10, right there. So this is what we call our AM session. Anything before 9:30, that is what we're always looking for. Now let us see whether we would have caught any trade on a Monday. See, it was a bit choppy, but we always look for liquidity. Where is the next liquidity? Now let us check keenly together. Between 7 and 8, the first high that was created was this one, right there. I'm going to outline it as a buy side liquidity. I'm just going to extend it and put text and you see buy side liquidity. And the low that was created between 7 and 8 was this one. I love to put them in green because it's kind of green grass, you know, green grounds. That's what I love. Then we're going to call this one our sell side liquidity. Sell side liquidity. Sorry for that. Now let us try and see whether there's a recurring thing that ICT has taught us. I hope you're following. Now, before 7, there was a high. These were two equal highs that were taken out by this small rally, short rally. Then the market went all the way down and created this low. After that, the first thing we did is we took out this liquidity, the buy side liquidity. Then the market went all the way down. It went all the way down, created this low again. Let me just extend a little bit right there. Let me extend it until 9:30 when the market opens. So once this liquidity was taken, let us try and see whether there was a short sale or anything that we would have tried to catch at that area. So I'll just try and remove this so that you can see that there was a key low right here before this liquidity was taken, buy side liquidity was taken. After that, we can see clearly that this low was taken out by this candle. Then the market dropped further. Then you can see this down close candle. The market retraced higher, and you can see that it came to a specific area right here. So let us see whether how many things can we see right here. Number one, we can see that this was a down close candle, and at the same time, let me just change this so that it doesn't extend to the right. I want it to be as simple as possible. Something like that, yeah. So the market came all the way up, and if I was to give a bias of why the market came all the way right here, is because number one, once the market takes a low like the way it took right here, it gave us a fair value right there, but when it retraced, we can see that clearly the fair value actually restricted or was respected by these bodies, but the wicks did the damage and went higher. But what were they coming for right here? If we say it is this CB that was being created right here, I would say it's one of the reasons. But since there was something that was before this CB. As you can see, there's this down close candle, then there was a push. The market first went all the way down to take out this previous low and created this low. Then it went higher and took out this liquidity. So it means that this was the breaker. This, you see this down close candle right there, when the market closed below it. So I think if I'm supposed to show why the market retraced, I would rather stick with the breaker, because it is the one that actually gave us a quick response, where the market came all the way up and gave us this wick, never came closer to this, the midpoint of that down close candle. After that, the market went all the way down. This would have been a small scalp, because you can see it just wicked, and this fair value that was right here, let me just highlight it so that you can see that actually the bodies respected it. They didn't actually, it did a little dirt, but it is because at the same time, we're just trying to get a bias. Will the market respect what it is giving us? Suppose this is our breaker. What we expect is, if the market was to come back, it would have tested it right at the top and continue. But what it did, after taking out the buy side liquidity, the market closed below the breaker, and now once we see that a low has been taken, right there we check whether there is a fair value, and once the market comes back to it, it's when we take our sell trade. And if we took it and we placed our stop loss right below, without thinking that the market can actually wick, we have to give some room for the market to play. And I believe that if we were to place any trade right there, our short would have been something like this. We take our sell right there, but our stop loss right above the breaker, so that in case the market wicks, it won't take you out. Then if our bias would have been to target this sell side liquidity, we see that it is clear that we wouldn't have gotten this trade. But what we do is that once we have a bias of where the market is going, as you can see, there are many areas where the market would have come. Number one is right below this up close candle, there was a CB, there was a BC, and below it there was another one right here. So these are areas where we would have actually taken at least more of the percentage of the trade that was running. Let's say if you took out 50% right there, then when it reached here, you took out, let's say, something like 80. By the time you're leaving one trade to take out this low, 80% you've already locked in. And I believe it's not about getting the home run, but a fraction is better than nothing. And once you saw that it is actually kind of respecting this down close candle right here, let me just show you what I mean by respecting. If I was to take this down close candle, the one that's right there, exactly right there, we can see that the bodies didn't want to actually close inside or below it. That would have been a great instinct, or a way to tell you that you should actually get out, because this sell side liquidity is not going to be taken right away. After that, we can see that the market came all the way up. Let me just, it didn't take out the buy side liquidity that was created right here. It just came all the way up. There was a deep retracement, went down again, and now ran for this liquidity. But we can see that this would have been a small scalp. Without being greedy and with good risk management, then this would have been actually a good trade, and you would have been done for the day. Then after that, we can see that the market took out the sell-side liquidity. During the open, it took out, after taking out the sell-side liquidity. Now, between 9:30 and 10, the first thing it did was created a BC right here, retested it while taking out this buy-side liquidity right here. Let me just show you right there. I'm just going to put it in blue so that you see. Right there, this is buy-side liquidity. Buy-side liquidity. Yeah, come on. Buy-side liquidity, right there. You can see that it took out this, then it ran fast for this one. Retested the CB as well as we can take it as a fair value, and it went all the way up to where our new opening week opening gap is, and that would have still been a good trade from right here when the market was retesting the fair value or the BC. Then you target the low of that new week opening gap, and that would have been actually good trade. I hope you found this insightful. For now, I just wanted to show you how do I look at the market based on ICT concepts. And I believe that now you're currently seeing that this thing is actually recurring. It's about getting having an edge, and having an edge means really to find a way of knowing if the market is going to take out these people right here at the buy side liquidity. Where am I expecting the next liquidity to be taken? Then how will I enter? And you can see that this would have been a good approach right here. And as much as it didn't give you the whole home run to take out the next liquidity, at least you got away with more out of this analysis from right here to where we had this BC. So hoping that you found this insightful. I would really love if you just appreciate it with a thumbs up, comment. If you have anything to add, we can always learn together. And the whole point of this is to make money. And if you can't make money, at least gain knowledge. So with that, don't forget to subscribe. We're going to help each other out, and I'm hopeful that as I continue teaching and as I continue learning, I will be better, and we will be better together. So for now, God bless you, and see you in the next one.